Hey guys, it's Julius and welcome back to another video. Now, as an investor, it's hard to look at your portfolio and see it going down. Now, however, that's the advantage of long-term investing. Last week, I saw my portfolio hitting all-time highs, and now this week, my portfolio has been declining. Now, which got me wondering, is the stock market about to crash? Now, with this year's pandemic, most of the non-essential businesses have been shut down, which has pushed over 20 million people out of work. And this has caused a massive fluctuation on the Wall Street. Now, this has been a wild year. In less than 5 weeks, we saw the SP 500 plunge over 34%, representing the fastest bear market decline in history. But then in the following 3 months, we saw the index gaining back what it had lost. As I say, it's been a quiet year. However, history suggests that another stock market crash or correction is coming. Now, of the past 8 bear markets, there have been 13 total corrections of at least 10% within the last 3 years. In other words, you need to be prepared for the next stock market crash. So in this video, we're going to look at 8 things that you need to know or do when the next big crash or correction coming up. The first thing that you need to do, you need to relax. Now, first of all, stock market crashes and corrections are a natural part of the investing cycle, and they are going to happen whether you want it or not. Now, since the beginning of 1950, the SP 500 has undergone 38 corrections, working out to a correction roughly every 1 year and 8 months. And they're a lot more common than you probably realize. The next thing that you need to do, you need to understand that corrections are short-lived. While unpleasant, stock market crashes and corrections tend to be very short-lived. Now, with the pandemic, for example, the crash lasted for a mere 33 calendar days. Now, since 1950, 24 of the 38 stock market corrections in the SP 500 have found their bottom in 104 calendar days. That is 3.5 months. In fact, only 3 corrections in the past 36 years have lasted longer than 104 days. Computers and the internet have leveled the playing field between Wall Street and Main Street in terms of access to information, which in my view is likely responsible for these shorter periods spent in corrections. Next, you need to keep your emotions out of the equation. As an investor, you need to be wise to keep your emotions out of decision-making process. Now, why emotions tend to drive stock market crashes? Operating earnings growth is what sends stock higher over the long run. Therefore, short-term worries rarely have a lasting impact on the growth potential of great companies. Now, if you panic and sell during a corrections, there is a good chance you are going to regret it. Next, you need to avoid timing the market. You see, everyone has their own method of buying stocks that makes them feel comfortable. Now, during a stock market crash, folks need to be more careful because with the most brokerages eliminating commission fees tied to buying and selling stocks on major US exchanges, you can dip your toe into the pond and take small bites of great companies as often as you'd like. Plus, since timing the market isn't something that can be done with any accuracy, then why bother? I personally believe taking caution will ensure your chance to buying high quality businesses at a good discount. Next, you need to think long term. You have to think long term if you want to compound your wealth many times over. Now, there's no question that there is going to be a lot of noise in the short term from time to time, but in most instances, this short-term noise fades over time. Always remember that operating earnings, growth, and innovation is what drives long-term valuations, not emotions. Next, you need to trust in diversification. Now, when a market decline hits, your result may vary, and perhaps for the better. If you have invested money across different baskets of asset classes, all you have to do is sit down and just relax and let your money work for you. Now, if you invest in index funds like the SP 500, diversification already is built in. I mean, you will still experience some painful short-term drop, but this will help you avoid losses from which your portfolio can't recover. And when the dust settles, you will probably need to make some adjustments to that mix, for example, rebalancing your portfolio. since it's likely being thrown out of work. Number 7 is you need to remember your risk level. Even though the stock market has its roller coaster moments, the downturns are ultimately overshadowed by longer periods of sustained growth. Now that's the reality on paper. If only our brains accepted that and didn't trigger emotion-driven reactions like selling during a market dip and possibly missing the eventual upstick. You see, investing in the stock market is not as risky as people make it to look. But what makes for winning long-term returns is the ability to ride out the downfall and remain invested for the eventual recovery, which historically speaking is always going to happen. Now you'll be able to do that if you know how much volatility you're willing to stomach in exchange for higher potential returns. Lastly, you need to be ready to buy the dip. Now market dips are when fortunes can be made. Now the trick is to be ready for the fall and willing to commit some cash to snap up investments whose prices are dropping. Now you probably won't catch the stock at its low, but that's fine. The point is to be opportunistic on investments you think have good long-term potential. Now keep a running wish list of individual stocks you would like to own. You need to set aside some cash so you are ready to for a flash sale when a disaster strikes. Now one strategy to overcome the fear of bad timing is to dollar cost average your way into the investment. Now dollar cost averaging smooths your purchase price over time and puts your money to work when other investors are on their sideline. Now I understand that was a lot to take in, but if you can't take in anything from this video, at least take 2 points from this video. That's diversification and investing for long term. This will save you lots and lots of headaches. If you can try to remember that what happens when you sell your investments in a downturn, that's when you lock in your losses. Now if you plan to re-enter the market at a better time, chances are you're going to pay more. Now thanks again for watching another video of dividend investing. Don't forget to hit the like button and consider subscribing to join the journey of investing. See you in my next video.